Behind me is New York's biggest landmark to the big freeze in the credit markets. It was one of the biggest additions to the Manhattan skyline in years, the signature new headquarters of Bear Stearns. But now there's no clue that Bear Stearns ever existed. Bear lost the confidence of its trading partners last March and ran out of money. It was bought for a pittance by JP Morgan, and it's their name that now goes above the door. It's a monument to the overconfidence that caused the worst financial crisis since the war. Let's show you what happened.
This is the ABX index. It shows you how much of every dollar people in the market thought they would get back from securities backed by subprime mortgages. As we all now know, they were lent to people with bad credit. Early last year, the market assumed there would be barely any defaults. Then the slide began. It turned into crisis in July when Bear Stearns admitted it couldn't put a value on the subprime mortgage-backed securities in its own hedge funds. And now, as you can see, the market assumes those subprime mortgages are virtually worthless.
Since then, there's been a crisis every few months. The problems started with subprime, but they go much further.
The authorities have been reactive. Every time there's a peak in volatility, which we're showing you here with the VIX index, there's been a rescue from the government. The Fed cut rates in August when Countrywide was in trouble, and again in January when the bond insurers were in trouble. They forced the takeover of Bear Stearns and started lending to investment banks in March, and they came up with money to bolster Fannie Mae and Freddie Mac, the big mortgage agencies, last month. Every time, people thought the worst was over and there was a rally, but the trend stayed down.
But some saw all of this coming, and they could make money. Jim Melcher is a champion fencer who also runs a hedge fund called Balestra Capital. I first spoke to him back in 2006 when the markets were still booming. But what he saw was that America had become wildly overextended.
For the first time ever, Americans were spending more than they earned, as you can see from this chart. Meanwhile, debt was out of control, much higher than income. Very unusually, Americans borrowed and spent even more through the last recession. This obviously couldn't last. When the trend broke, he could see the build-up of debt was so huge that it would take years to get back on track.
Fencers know not to trust their gut instinct. They have to be disciplined, and it's the same for investors. What he saw then was a historic underpricing of risk. Taking only tiny risks himself, he placed a series of bets that the value of subprime mortgages would collapse. Those bets were in place more than a year before the big freeze started, and the value of his hedge fund increased 200% in 2007. So, you called 2007 right. A lot of people now are saying that we've hit rock bottom, that now could be the time to buy. Do you agree?
No, I do not agree. I don't think we're anywhere near the bottom yet. We've been in a stock market and bond culture here that is looking for gains.
Right.
Overwhelmingly, people are invested looking for things to go up, and they interpret the facts accordingly.
And in some ways, does that help explain, in retrospect, what's so surprising isn't that you spotted what was coming, but that so few other people did? Is that because they had a vested interest in the stock market to go up?
Yes, and they were making also a lot of money writing insurance policies on bonds, credit default swaps. And we saw that opportunity. They were seriously mispriced. We were able to buy protection, which means insurance, betting that prices would fall, we'd make a profit on it, at ridiculously low levels, and we took advantage of that, understanding that the mortgage-backed securities were worth almost nothing, while the market was saying they were worth everything.
Now, I mean, we've had about a year now of real panic in the markets. I mean, is it fair to assume that you don't have that kind of opportunity to really benefit from mispricing anymore? Or are there ways in which you can still profit or hedge against the worst of what's yet to come?
Well, the mortgage-backed securities are largely washed out, but we've moved on to other areas that are also mispriced, although perhaps not as seriously mispriced. But because people still want to believe that markets will go up, that they've seen the bottom, that presents us with excellent opportunities for profit here.
Now, we've seen particular panic selling in financial stocks in recent months. I mean, is it fair to assume that you've got more opportunities betting against some of the bigger companies outside the financial sector where the share price is barely down from the top?
Yes. Well, the financial markets probably have further to fall. We're still maybe less than halfway along on that. Other areas, the industrials, emerging markets, the mining companies, they provide rather good opportunities because those stock prices are still relatively near their highs, but they're going to be impacted by these negative events almost as badly as the mortgage-backed securities were.
That's quite a worryingly long list. Thank you very much. So, what are the key things to worry about now that the big freeze is a year old? Well, first of all, we should worry about what you might call the Alan Greenspan test. Back in June, Greenspan, the former head of the Fed, said that the credit squeeze was coming to an end and we would know when it was over when the spread of LIBOR over overnight rates dropped to 50 basis points.
What this shows is the extra amount in interest that banks must pay to borrow from each other compared to the target rate set by central banks. The bigger the gap, the more the banks distrust each other and their collateral, and the more problems for the financial system. The bottom line is clear enough. They don't trust each other any more than they did 12 months ago, here or in Europe or in the UK. If they do get back to Alan Greenspan's 50 points, that would be positive.
There's another key variable, house prices. People got so optimistic about the risks of mortgages because they were using backward-looking models. In history, people only very rarely default on their mortgages. But that was a history in which prices were rising all the time.
As you can see, that's no longer true. In the big US cities, house prices peaked 2 years ago and they're down 20%. If you believe the futures market, they have at least another 15% to go. Will people try to hold on to their house if it is worth much less than their mortgage? Or will they default? And it gets worse. As you can see, house prices in Spain and the UK and in a few other markets got even more overheated than they did in America. They could now have further to fall. The further the fall, the bigger the problem for the banks, and the bigger the hit for the economy.
The next big issue, how does this affect banks? Mr. Market isn't going to be the same source of credit he used to be, so instead we're going to have to go back to the old way of doing things, where banks' lending officers decided whether or not to make a loan. Let's take a look at a survey taken by the Fed of what those senior lending officers are planning to do.
The problem is that the banks find it harder to raise money themselves because of the squeeze, and they've taken huge losses thanks to bad mortgages. If they had less money, that puts pressure on them to lend less and make their standards tougher. As you can see, the squeeze is on. Most banks are tightening standards for lending, whether it's mortgages, credit cards, or other loans. And as you can see from the broken out figures for the last 2 years, they're tightening the screws on prime mortgages almost as much as on subprime. Banks in Europe are doing much the same thing.
Worst of all would be if banks close altogether. So far there's been a rescue of some kind or another for all the institutions that have gone into trouble. Countrywide, Fannie Mae, Freddie Mac and Bear Stearns. But that can't go on forever. If the authorities want to stop another wave of financiers stupidly underestimating risk like this in the future, they'll have to let someone fail. That would ram home to everyone what the real risks are. Now, we've already seen some small banks fail here in the US, but if one of the bigger commercial banks were to go down, that would be a much bigger hit for the economy. And it's obvious that on both the stock market and the credit market, people are worried that that could happen. If it does, then the biggest fear of all will be realised. With credit drying up for consumers and for businesses, the crisis for the financial markets will at last have transformed into a crisis for the economy. This is John Authers reporting for FT.com from Midtown Manhattan.